We're going to take a look at recording costs in a standard costing system. But first, we're going to look at how we would record costs using a normal accounting system or normal costing system. We've got information regarding our standard costs and our actual costs and our actual level of production. In a normal accounting system, we record costs at their actual or historical amounts. Let's go ahead and take a look at recording the purchase of raw materials. In this case, we've purchased $130,560 of raw materials, and we debit raw materials inventory, and we'll credit accounts payable for the same amount. Now let's go ahead and record the purchase or payment of direct labor costs. When we pay direct labor costs, we debit work in process for the direct labor, $111,280, and we'll credit salaries payable or cash, some sort of count along those lines. And then, of course, for manufacturing overhead, we will debit variable manufacturing overhead, the actual side or the left-hand side of the account, and we will credit some sort of accounts payable. When we apply manufacturing overhead, and again, we apply it on the basis of our predetermined overhead rate and some actual activity level, and in this case our predetermined overhead rate is $8 per direct labor hour, and we've worked a total of 8,560 hours. So we will apply $68,480 in manufacturing overhead, and again this is simply our actual hours, 85,560 times our predetermined overhead rate of $8 per hour. And always notice our actual overhead of $73,000 doesn't equal our applied overhead of $68,000, so we would have closed out or zeroed out any underapplied manufacturing overhead to cost of goods sold. So we'll debit cost of goods sold for $4,720, and we will debit variable manufacturing overhead or credit variable manufacturing overhead applied for $4,720. And again, this is how we would record transactions in a normal accounting system. As a first step, we would calculate our material price and our material quantity variances, and I'll leave that up to you to do. Recall, we were operating at a production and sales level of 44,000 units. Let's begin by recording the purchase of raw materials. When we record the purchase of raw materials, we're going to record the purchase of raw materials at the standard or cost. And in this case, we had purchased 81,600 pounds of raw materials at a standard price of $1.50 per pound. So we would record $122,400 in raw materials inventory. But of course, in terms of payment, our vendors are expecting a payment of the actual price, which in this case was $130,560. So we'll need to credit accounts payable for the amount we actually owe our supplier. The difference between the $130,000 and the $122,000 will be recorded as a price variance. In this case, it will be a debit to our materials price variance for $81,160. When we issue materials to production, again, we will do it at its standard price. And so when we debit work in process, we will debit work in process for the standard quantity and the standard price of $132,000. And again, that was 44,000 units. At 2 gallons per unit, there's our standard quantity of 88,000 multiplied by our standard price of $1.50. The materials were in our raw materials inventory at an actual price, or rather a standard price, but at an actual quantity. And we used all 81,600. So we'll take it out of raw materials inventory at the 81,600 gallons at $1.50 per gallon. The difference between the two will get recorded to our raw materials quantity variance. The last step then is just like with under or over applied manufacturing overhead. We need to, at the end of the period, close out or zero out our material price variance and our material quantity variance. And we'll do this by closing them to cost of goods sold. Our materials price quantity variance had a $9,600 credit balance, so we'll debit it for 96. We will credit the materials price variance, and the difference of $1,440 will get credited to cost of goods sold. And let's go ahead and take a look for a second at what was going on. We actually spent $130,000 on raw materials, spent and used $130,000 worth of raw materials. But because we record things at standard, we recorded a charge of $132,000 to our work in process inventory. So our work in process inventory was too high by $1,440,000. And of course, if work in process is too high by $1,440, finished goods will be too high by that amount, and cost of goods sold will be too high by that amount. So that's why we ultimately then reduce cost of goods sold by the $1,440. Let's go ahead now and take a look at our direct materials variances. Again, our first step is to record our direct material labor costs at standard. And our standard hours allowed was 8,800 hours, because again, that was 44,000 units at 0.2 of an hour per unit. And multiply that by our standard rate of $14 per hour. So at standard, we would have expected this level of output to cost $123,200. But our actual labor cost was $111,280. That's what we're going to pay our employees. The difference between the two we break down into the rate variance and the labor efficiency variance. And again, debits equal credits. Of course, at the end of the period, just like we would with under or over applied overhead, we need to close out our labor rate variance and our efficiency variances. And once again, we will close these out to cost of goods sold. In this case, the amount we charged to work in process, $123,000, was higher than the actual amount we paid. So in other words, work in process is too high, which means finished goods will be too high, which ultimately will mean cost of goods sold will be too high. So to close this out, we will debit our labor rate variance as well as our labor efficiency variance, and we will credit cost of goods sold, which serves to reduce cost of goods sold. Finally, let's go ahead and record our variable overhead efficiency variances and our price variance. Again, we record our variable overhead at its standard cost. Our standard cost for variable overhead was going to be $70,400. That was our predetermined overhead rate of $8 per hour times our standard hours of 8,800 hours. In terms of our actual overhead cost, we would have actually incurred $73,200 in costs. And so we would have, of course, credited cash or credited accounts payable for that amount. The difference between what we recorded at standard and what we actually incurred will be broken down into our variances. Our price variance was $4,720, and it was an unfavorable variance. And our efficiency variance was $1,920, favorable variance. And once again, we noticed debits equal credits. And again, just like with variable overhead, we'll close our variances out at the end of the period to cost of goods sold. And so we start by zeroing out our efficiency variance, $19,200. We zero out our price variance, $4,720, and the difference will go to cost of goods sold. Notice this time it's a debit to cost of goods sold for $2,800 because the amount that we incurred for actual overhead, $73,000, was higher than the amount we applied using our standard costs.